founder or an entrepreneur. If you want to take your company value to 300 million, we gon' show you how to do it. But we got the roadmap, the aspirations. We'll give you a game plan and strategies. Seize control of your company's destiny today by tuning in to Private Capital Mastery. Yeah. Let's start the show.
Welcome back to the Private Capital Mastery podcast and community. I'm your host, Brian Franco, and today I'm joined by Tim Team. We're going to unpack some exciting details in and around data-driven exits and how you can prepare your company for liquidity events, better known as exits and sales, and capital readiness. Typically comes in the form of growth capital and expansion capital. Without any further delay, Tim, welcome, and thanks for being here with me today. How are you?
Brian, thank you for having me. I'm doing well. Happy to be here with you.
Yeah, me too. And we had a great conversation last week, and it was kind of fun to identify with your company name, Blue Ocean, and interesting enough, we were working on a project right now with that same project name. So it was hard not to think about and connect those two dots last week. But thank you for being here today. And, tell us a little bit about yourself, the work that you do, where have you been? What are you doing today? And how can you help those in the future?
Appreciate that. So my entire career, I've been an entrepreneur. I've been in the trenches as an owner operator, focused primarily on business to business organizations, small to medium-sized businesses, anywhere from 5 million to 75 million in revenue. Mm-hmm. And so I have a pretty unique perspective, having been there, done that kind of mentality.
Yes.
So the work we do now, and probably over the past 20 years, what we focus on is helping the C-suite, the business leader, the owner operator, move their company from point A to point B, whether that's through revenue enhancement, EBITDA enhancement, or in this case, preparing for a capital event or preparing for an exit.
Absolutely. And, we love the work that you do because it ultimately allows us to drive a process and be deal ready, with anywhere from data room to due diligence, which I'd love to talk about because, that's with your experiences and my experiences put together. We can both share war stories of the times that we weren't prepared and how that impacted the speed in which we moved, or even potentially indefinitely delayed some of these transactions that we worked on historically. And so, and that's really the purpose of this podcast, is really to provoke thought and educate those that are, wherever they are on their journey, right? They're thinking about this, they heard about, but the private capital markets, they're thinking about an exit. How do they ready themselves? Because a lot of times what we find is clients think that they're ready just because they say they are. And that's not the case, right? This takes time, energy, and careful planning. So, let's talk about a data room. So in creating that data room, because this is where we're going to have an index and a library of information. And I remind, clients on the south side end of the table that the burden of proof is on our side of the table because someone else is looking to acquire us. They have a fiduciary responsibility back to their investors and LPs and partners. So they need to make sure they're checking those boxes all the way through, right? So the concept of the data room can be new to some, but for you and I, it's part of our everyday interactions with opportunities. But can you explain, how you've prepared a company by successfully utilizing a data room, and more importantly, because I don't want folks to think it's just a bunch of financial data just thrown into a folder and for everyone else to sift and sort through, right? Give us some perspective there and what you've done to prepare clients from that standpoint.
Well, I think the biggest thing we start with first is managing expectations.
Yes.
In many instances, the entrepreneur, and let me start by saying I love entrepreneurs. So this is not an indictment. It takes a special person to change a tire on a moving car, right? This is a unique personality. I love them. I was one. And most of the time we find out that the expectations are, hey, I'm going to run some financials off of QuickBooks. I've got a couple of Excel spreadsheets from the sales department. Why don't we just PDF and email that over, and isn't that sufficient? So the biggest role we play is making sure it does not become antagonistic. You know, most entrepreneurs are strong personalities, most C-suite strong personality. And it's like, my God, how many times do I got to rework these projections? So we start with, of course, it's always nice to have reviewed or audited statements. Probably not going to happen in most SMBs. So, you get as close as you can, a couple of years of tax returns, a couple of years maybe of adjusted financial statements. Sales projections are always nice. Then you find that most clients aren't using a really sophisticated CRM system, so you are recreating it on an Excel spreadsheet. So what we try to explain is what's really helped, a great analogy for us. If you go to buy a used car now, there's a service called Carfax, because most people,
yeah, I'm familiar with it.
What we're creating in a data room is the Carfax for your business. How has it performed historically? And from that, somebody can make an expectation of the valuation.
And you're right, having audited financials, reviewed financials, or even a third-party quality of earnings report, a proof of cash, anything from a third party is going to be viewed differently than, versus internally prepared financials. Simply because, there's a certain method that a third party would take in reviewing those financials or auditing those financials. So I think that's a great place to start. We encourage the same thing with our clients. And in fact, we have to find a reason not to do it, to advise not to do it. But I can't think of a case study where we've done that recently. And just simply because there's a lot of information to unpack. And the measurements that a business owner makes of their own company is not the same that you and I are going to make for a capital event. But with that said, if I'm preparing for an exit, I'm at a time in my life where I want to retire or I want to move on, I want to sell my company. Is my data room much different than those that are looking to raise capital for growth? And if not, what differentiates the two scenarios?
Well, when you're leading up to any type of transaction, what we've always found is the prospective buyer or investor who we're talking to, 9 times out of 10, they give you an inventory list of what they'd like to see in the data room.
Yes.
So it kind of does help you along. You're not left guessing. You're not wondering, what are they looking for? You'll get, I want 3 years of financial statements. I want some sensitized sales projections. I want your top 25 customers, client concentration risks, things of that nature, your cash flow statements. So the buyer or investor, they'll help you along. They're just not going to do the work. It's up to us, and certainly up to a firm like yours to help people understand. And I think that's the biggest issue, Brian. Most entrepreneurs are so busy running their business. They don't realize this is a business unto itself, raising money or selling your company. It needs professionals to come in and handle it for you.
And that's why our firm Meritage Partners really emphasizes that, because we want them, our clients, them being our clients, to continue to run and operate their business, handle the day-to-day, and we want to disturb them as little as possible. And so what we do is, to your point, is we anticipate which documents will be needed depending on what type of capital event we're pursuing, and then we prepare accordingly. But as you described earlier in this session here together, it's all about managing expectations. And I'll tell you, I mean, this has been a thought of mine for a time now, is I almost want to write a book titled, Managing Expectations, right? It can be applied really to anything in life. Because when you come together with 2 or more people, there's typically expectations that we have of one another. And in that specific setting of, capital events, there's an expectation that a client raising capital or a client looking for an exit is going to have most, if not all, the data that they want to see, right? But let's talk about some more stories. In situations where someone has, neglected data room preparation, right? Or misunderstanding what a data room is and what it should be populated with. I mean, any instances that you can share, by way of description that kind of speaks to that problem and the pain that's associated with not having the right data in a data room.
You're short-circuiting yourself. It's a self-inflicted wound, as we like to tell people, if you're, and let's stick with the car analogy, it's selling a dirty car that hasn't been cleaned, that hasn't been maintained, and you're wondering why you're not getting top dollar offers. So the data room is that third party representation of what the value of your business potentially could be. Now, that's just where the negotiations begin, but clearly we always say to the C-suite, we want to put our best foot forward in the data room, because we don't know who's extracting this data within the company, how they're reformatting it for their team, and what expectations they have. So it usually prevents a lot of, what do you mean my business is worth X? I think it's worth 3X. That's why it's incumbent to have quality of data.
It really is. And, you know, I've seen that, to your point, it is a self-inflicted wound. And ultimately, you know, any sort of inconclusive data or incomplete data is likely perceived by an investor or a buyer as a risk, right? Because they're left to fill in the blank, or to come to a conclusion that they can't come to by reviewing the data. And that's not what they do. That's not what investors or buyers, that's not how they operate. That's not how they underwrite. And because of that, you know, they're more likely to, I don't want to say walk away from a deal, but prioritize the deal lower on their list, because you and I both know that equity groups and independent sponsors and family offices are looking at opportunities, and they'll have to look at, you know, 1,000, 1,200 opportunities to get to one or two, right? And so, you know, and we've sat on each other's side of the table before, and, you know, from the buy side and from the investment side, you have limited time to make a decision. And it's painful if you're having to wait for someone to figure out what data to provide you and what format to provide you. And there again, I mean, this is ultimately, I've thought about this a lot, Tim, and I haven't figured out a way to collapse time while running a process. The only way you can collapse time is preparing ahead of time, you know, before going to market. Don't you agree?
I totally agree. It's, you know, reminds me of the Chinese proverb, right? The best time to plant a tree is 20 years ago. The next best time is today.
I like that.
You know, we're always working with clients. Here's a case in point. If most entrepreneurs, most C-suite, they know how to scale a business.
Yes.
It's second nature to them. They know how to get it from 1 million to 5 million to 10 million. We always tell them, you can't spell scale without sale. Prepare the business as if you were going to sell. You don't have to sell it, but run it as if you were going to sell it, because 3 years, 4 years, it goes by at the blink of an eye. That's not the time to start preparing the business for sale. Hey, I want to sell in 6 months. Now let's get all these, you know, investor ready documents together. Run it as if you're ready to sell it.
It's like, it's funny. It's like I'm looking at a mirror listening to you say that, because I've made investments along the way. And there was one company in particular that I'm thinking of. We acquired, we quadrupled the revenues in 3 years. We had one acquisition. And as a leader of that team, I always stated the same thing. We're going to run this company as we're going to sell it. And the question was always, well, why are we going to sell it? And I said, no, that's not the point. The point is that we're going to be accountable to somebody else besides us sitting in the room, right, to what we're doing today. And if we do that, when that opportunity comes, we'll be ready. And I repeated that hundreds and hundreds of times, and it really became that accountability mechanism that we all needed to behave in such a way that allowed us to build that company, not just for purpose of growing revenue, but scaling it in a meaningful way with meaningful profit, where everyone in the team can benefit and everyone flourished. And that's exactly what happened.
The other thing that's important about that advice that you're giving a client, most people think the last 6 months, the last year, we've had a great run up in revenue.
Okay.
If you do a quality of earnings report, or if somebody is looking at the history of your company, the first they're going to say is, well, what's the average client retention? 3-4 years.
Yes.
Well, I'm not going to give 1 year's worth of revenue the same value I would give 4 years worth of retained revenue. So this run up doesn't get valued at the full impact that you think it does. So by not being aware of this, the opportunity tends to get antagonistic, as you know. It gets very frustrating. They told me it was 4 times EBITDA, 8 times EBITDA. Well, here's my EBITDA. Well, there's a lot of one-time charges in there. You're not going to
Yes.
get credit for that. So that kind of comes back to what you're telling your group. Let's run it as if we're going to sell it. It's what I tell people. Let's run it as if we're going to sell it. And then these things tend to take care of themselves because you've been doing them since inception or soon
Precisely.
after.
Absolutely. I couldn't agree with you more. So Tim, we've talked about a lot here and a lot of good information, a lot of good details. But I want to come to a close here. And in that closing, I want to pick your brain on, what advice would you give somebody that is out there, they're listening to us talk. I mean, some of what we're saying is resonating. Some of the things we're saying they've heard for the first time, right? But it's in its simplest form. I mean, what if someone out there is just starting this process? And when I say starting the process, I mean, they're exploring an exit or they're exploring a capital partner to help them grow and scale the business beyond its current size and scale. What advice would you give them, and how early, should they be starting? And we probably reflect back to your Chinese proverb, but I always say, there should be an exit strategy plan the same day you create the business plan, but that doesn't always happen.
Right. Right. Brian, I'm not having been there and having made this mistake. I feel that I can share it. I'm not judging anybody, but they need to get your firm involved sooner rather than later. Here's why. The
Yes.
moment a C-suite or a management team is sitting around saying, we need to think about this, maybe some business combination, maybe some liquidity event, maybe some exit should be, even if you're a CEO, and I find it interesting when you find very large companies with CEOs who are deal makers themselves, they always bring in outside help. There's a reason for that. It's the client that represents himself in a court, right? It's that whole concept. You need to remove yourself from that. You have to run the business. They have to run the book. So bring somebody in that can tell you, here's what the market is. The first 3-4 conversations are probably going to happen over 6 weeks. You're not getting rushed into a transaction. You don't show up and say, here's my retainer. It's more along the lines of, let's kind of scope this out and see what we can do together. So it's the biggest piece of advice. People wait too long or don't bring anybody in to begin with. You need to bring in help.
I love that. I love that. And it's, you can't pretend to be ready. You have to practice being ready. So you are ready. So when that opportunity does present itself, you don't have to fake anything. Your data room's ready. Your data's indexed, because you need to have this library of information for a multitude of reasons, but this capital events are certainly one of those high priority reasons to be ready. And Tim, I'll tell you, I've enjoyed our conversations. I enjoyed you being on this program and provoking the thought and allowing those to hear your experiences, because this is not something you necessarily learn in a textbook. You learn it through experience and stubbing your toe here and there, and we've all done it. I've done it. And but that's where the wisdom comes from. And thank you for sharing that wisdom, and thank you for being with us today.
Brian, my pleasure. Thank you so much. Good spending time with you.
Yeah, good spending time with you, Tim. And thank you for tuning in to this episode of the Private Capital Mastery Podcast. We hope you enjoyed the time, and we look forward to seeing you next week, where we demystify and unpack more in and around the private capital markets. I'm Brian Franco. We'll see you soon.